This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, well, it's time to test out now whether we've understood the issues that we've dealt with up until now by having to go as promised at example 1. Now, again, I trust that prior to this you have checked back through all the individual exercises that we have done, so we can now attempt to piece it all together in this exam standard question. Now, as regards our requirement on this question, it's set in the form of a written form question. Compute the amount of IHT payable during Joe's lifetime and upon his death. So during Joe's lifetime, that therefore means it would only be CLTs that were chargeable when made. You don't normally pay inheritance tax while you're alive. That pleasure awaits you for when you're dead. But if you've made a transfer into a trust to CLT, then there may indeed be tax to pay. It's certainly chargeable anyway in lifetime. Then upon the death, well, that of course is where you're going to tax both CLTs to any additional tax plus pets, and you're also going to then tax the chargeable estate at death. So we're going to have here a full set of computations. Now, to deal either with those CLTs, chargeable when made, or the CLTs and pets chargeable on death, you need to have a chargeable transfer figure. So that means that before any of that work can be done, you've got to work out the chargeable transfer figures. Okay, so we know what we're up for. Again, if it does come up, as probably it would in terms of a section B, then you'll have your 5 individual objective testing questions that would take you through the individual exercises that we're about to deal with. Computing the chargeable transfers, dealing with the CLTs chargeable when made, dealing with both CLTs and pets chargeable on death, dealing with the chargeable estate at death, computing any tax payable thereon, and potentially even, of course, stating when that tax will be paid. But we're going to approach this on a sort of cradle, dare I say it, to grave exercise from start to finish, looking at all of these aspects. So, back to the question. So we're told our humorously entitled and appropriately named Joe Kerr died on the 1st of April 2018. Right, now look at what we're told. Now it gets interesting in terms of the work that you have to do. Leaving £250,000 to his wife. What do you know about transfers to spouses? That means, of course, that will be exempt. And the remainder of his estate to his son. Remainder of his estate to his son. Therefore, that will be chargeable. At the date of death, Joe owned the following assets. Now, although this is the last bit of the exercise we'll be doing, the chargeable estate at death, still on our first run through, as we read the information, we can pick up incredibly useful stuff that's going to allow us to be able to deal with each part of the problem, again, in turn, but properly at that point in time. Now, we're talking about the principal private main residence. Now, principal private residence. You've seen that term before, haven't you? And this is a deliberate move on behalf of the examiners here, testing out whether you can distinguish between your two capital taxes. Principal private residence and principal private residence relief, that is capital gains tax. Well, there is no CGT on death. All we are doing is to compute IHT. So here, don't be put off by terms that ring a bell of saying, oh, that's an exemption, that's a relief, because that exemption or relief is probably in a different tax. Probably it is CGT. So be careful, please. So, principal private main residence. Now, that is a term that we need to know for IHT, because if there is a main residence, then what may be available? Yep, the residence nil rate band. Now, it's valued at £300,000, and we've got an outstanding repayment mortgage at the date of death, £80,000. It's a repayment mortgage. So, do we deduct that repayment mortgage from the value of the property? Yes, we do. If it's interest only, if it's repayment, then we deduct. Now, 80 from 300 will still leave 220. Big enough, therefore, for what then to apply? It's the main residence, It's about the residence nil rate band. It's only available if, of course, it's transferred to a direct descendant. And that's where this information is now relevant to this information here. That other than £250,000 worth of value, it does not say that that will be the principal or the main residence there. Everything else is going to his son. So we now know that there's a main residence being gifted on death to a direct descendant, and that therefore means we're talking about the availability of the residence nil rate band, £100,000. Now, of course, if we had dealt with someone who had a previous spouse who had not used, in the case of Joe, then her nil rate bands, then a residence nil rate band, of course, here may be doubled up from 100 to 200 if there was an unused nil rate band, as there would have been, unused residence nil rate band, I should say, which there would have been if a former spouse had died without using her residence nil rate band. Couldn't have used it, of course, before 1718 tax year, because there wasn't any residence nil rate band before 1718. But there's no reference to any former spouse. Clearly that would be very apparent, made very, very obvious to you to know whether or not there was an unused residence nil rate band or even an unused nil rate band available from the death of a former spouse. So here it's just the £100,000. Right, piece together therefore, where is the estate going? All bar £250,000 to the son. That includes a main residence, therefore equals the residence nil rate band. Other than that, in your death estate, it's a listing exercise. Holiday home valued at 140. Bank and Building Society deposits 230. ISA's market value of 150,000. 12,000 shares valued at £20 per share. 20 times 12, therefore, well, that's £240,000 value of those. What then have we got? Last one, a life assurance policy. Now, this is where they give you two figures. An open market value at the date of death, here 125, and then, because he's died, the proceeds of 140,000 that were received following Joe's death. So which of those do we use to include within the chargeable estate at death? As we should know, it's the proceeds figure. What comes away in determining the chargeable estate? As we said, it's a listing exercise. Back to the balance sheet, we've always made that point for the taxpayer at the date of death. So having listed out the assets, then it's about any allowable deductions for liabilities, expenses incurred. So outstanding credit card bills of £6,000 there at the date of his death. That will be an allowable deduction. What's this all about? Had also verbally promised to pay the medical expenses of £1,000 of a friend. That is not an allowable deduction. That is not a legally enforceable debt. Again, if any of the beneficiaries want to respect the, and here presumably the son, the wishes of Joe and pay that £1,000 out of their legacy to the friend, then so be it. But there's certainly no allowable deduction here in determining what is chargeable to tax. What there is an allowable deduction for, funeral expenses amounting to £6,000. So that's deductible, the credit card bills, that's deductible, the reasonable funeral expenses there. And then we get where most of our work is going to be involved, the lifetime transfers. So remember what we do. We must label each one and apply whether any exemptions, reliefs are available to you. So on the 20th of November 11, a cash gift of £40,000 to his son. So that therefore means we're dealing with a pet. Now then, pets only become chargeable on death if you die within 7 years of having made them. Now again, our hero died on the 1st of April 18. So is this date, the 20th of November 2011, within 7 years of that? Sadly it is. Sadly that is for the the lifetime beneficiaries, and again here the son. On the 20th of November 11, 7 years on from the 20th of November 11, we would have had the 20th of November 2018. Didn't last until then, lasted only till the 1st of April. So yes, that pet does become chargeable, but it's on the occasion of his wedding there. So what we'll have, occasion of wedding, son, so that's a marriage exemption of £5,000. You apply the marriage exemption first, but clearly that doesn't cover all of the £40,000. So what will be available? Annual exemptions will then follow on. So we'll have an annual exemption for the current tax year. What is the current tax year? November 11, that is in the 11-12 tax year. Was there any transfers in the previous year? No, these are the only lifetime transfers made. So we'll then get, and again remember the order, current year, annual exemption, plus then any unused annual exemption from the preceding tax year. That will be 10-11. And both of the full amounts of £3,000 will be available, as clearly 40,000 is big enough to eat up all of those annual exemptions. Okay, on we go. Let's just give myself a little bit more room to write there. To July 2012. So we've moved forward to the 12-13 tax year, transferred 405,000 I should say, into a trust. That therefore means that that is a CLT, and paid the IHT due thereon. So Joe, the donor, pays the tax on the CLT. That therefore means that that is a net transfer. Clearly, with a figure of 405, we're going to go above our nil rate band. Back then, and still, of course, we know it's 325,000. So that net transfer, it is relevant that we know that it is net because there will be tax to pay. And net, of course, means a what tax rate. If you can't answer that, you better go back and check it out there. Where the donor pays the tax, it is a net transfer. What does that make the lifetime rate? We then move on. Oh, sorry, before we do that, we've got to check out, of course, do we have available any deductions? Well, the only possible deduction here would be for an annual exemption. We've used up 11-12 and 10-11, but as we just said, July 12, we're now into the 12-13 tax year. So, yep, there will be available the annual exemption for 12-13. We've already used the 11-12, so just one annual exemption against it. Then on to December 16, gave 4,000 shares in Joe Limited to his son. Gift to son, again, it is a pet. And testing out our favourite valuation rule of all, that concept, of course, of the loss to the estate of the donor. Prior to the gift, Joe owned 16,000 of the 20,000 shares in Joe Limited. 16 out of 20. That therefore would equal an 80% interest. Share valuations have been agreed with HMRC at that date as follows. Now then, he gave 4,000 shares away. So before the transfer, he owned 16,000 shares. He gives away 4,000. After the transfer, he'll own 12,000 shares. So you will need to value before the transfer 16,000 shares at an 80% price. We are given the prices here. After the transfer, 4,000 out of 16,000 will bring you down to 12,000. 12,000 shares out of a grand total of 20 is now a 60% shareholding. So the 12,000 shares that remain will be valued at the 60% share price. We need to know, therefore, how to establish that transfer of value. What will we be able to do with that transfer of value once you've worked it out? It's to his son. It's not on the occasion of his wedding. Hopefully he's not going round again within 5 years of November 11, which was the first wedding there. So there's no marriage exemption. But of course, we've got some annual exemptions in play here. So on this PET, what we're also going to have is, of course, annual exemptions for December 16, that is 16-17. Previous year, 15-16. Have we used up the annual exemption of 15-16? No, of course we haven't. Therefore, we'll get 15-16 as well. And again, though we already know it, the nil rate band for 11-12 from the tax year 11-12 has always been 325. In fact, it's been 325 since the 09-10 tax year then. But again, the only one we're going to have to deal with is 325. Okay, so the approach. Again, if you can't remember, I hope you can from the approach to exam questions note that lies above this. The first thing that you've got to do is to compute the chargeable transfers, the chargeable transfer working. Now, we can see here that we've got 3 such transfers. We've got the PET, November 11, followed by the CLT, July 12, followed by a further PET, December 16. You set those up as columns on the right-hand side of your page, with date form in chronological order and labelling PET, CLT and PET. You compute, if necessary, the transfer of value. It will be necessary in relation to the transfer of shares. We've explained how we do that loss to the estate working. For the first PET and the CLT, the numbers are given, of course, at 40,000 and 405 respectively. We've already stated what exemptions are available against each of those transfers. You formalise that and put that into your working to establish the chargeable transfer figures, because we need those to then feed into the IHT computations required. Now, I need you to stall this at this point in time and then to work that. And when you come back, we'll have a look at the relevant section of the model answer to see whether you've got the numbers right. But you have a go at that first, then we'll explain that bit of the answer, and only that bit of the answer. Don't go looking ahead to anything else, please. That's called cheating. We'll look at that after you've done your chargeable transfer working. So again, please, if not already, stall at this point and then come back to us when you have completed your chargeable transfer working. Okay, well, I hope that you are looking at a working somewhat similar to the one that you can now see on the screen in front of you. The first computation, where necessary, but otherwise a copy down from the figure given in the question, is the transfer of value. That was given for the first PET, November 11, 40,000, given for the July 12 CLT, 405, but for the December 16 PET, we had to work it out. Here's your calculation of the transfer of value. What did our hero have before the transfer? 16,000 shares. That represented an 80% shareholding, and that carried a £25 per share price. He gave away 4,000 shares, so after the transfer had 12,000 shares. That was a 60% shareholding, and that carried with it an £18 per share price. So that therefore gives us a transfer of value of 184,000. In it goes. We'd already marked on our question page, as it were, there. You'd have jotted it down as you read the question, of course, in terms of your exercise there. But we saw that the first transfer, the first PET, was on the occasion of the son's marriage, so there was a marriage exemption. It was the first in the tax year, 11-12, so it got that annual exemption. There had been no transfers in the previous year, so we got the unused annual exemption brought forward from the previous year. And we've identified which it is there, 10-11. Again, in relation to an objective testing question that only wants a result at the end of this exercise, then of course we don't have to worry about our presentation or labelling there. We just need to know how to compute the figures. This is the way that we do it. On to July 12 CLT, then July 12, we're into 12-13. So we got the annual exemption for 12-13. We jump a few years to December 16 for the PET. Annual exemption for that year, 16-17. There it is. Hadn't used the 15-16, so we apply that as well. So we've now got our chargeable transfer figures. We will then, having seen now that we have chargeable transfers that include both a CLT and pets, but firstly that CLT is a lifetime transfer chargeable when made. The taxpayer died within 7 years of making all of these transfers, so there will then be a further computation, lifetime transfers chargeable on death. And having done that computation, and only having then done that computation, can we work out the tax on the chargeable estate at death. So what you now need to do is to go back again, if you need to, I'm hoping that you're already up for this, and look at the computation that we do in relation to a lifetime transfer chargeable when made. Now, your lifetime transfer chargeable when made is your CLT. So you'd now need to head up a computation, headed, as we've said, lifetime transfers chargeable when made. And you can see that just appearing on the screen there. And we should know that when doing that, there are 3 columns that we need to record. Oops, don't want to give you the answer yet. Hopefully you can see at the bottom of the screen there, where we have got a little inside a value column, a pound sign there, a working column to record the chargeable transfer. We then want to know the gross transfer, and we want to know the IHT. Okay, so there is one CLT. It is July 12. There is our chargeable transfer, £402,000. So on our lifetime transfers chargeable when made computation, we record on the left-hand side, having got the 3 columns on the right-hand side, what is the date of the transfer? It is July 2012 here, and July 2012 transfer, and that is a figure of 402,000. So we need to record the 402. We then need to know, were there any CLTs before that? Well, obviously not. We've got all 3 transfers, the only transfers made in lifetime here. So there were no CLTs made in the 7 years before it. So this will now use all of the available nil rate band. Remember, when taxing in lifetime the CLTs, we ignore any pets that may have been made before that. They do not eat up on this computation the available nil rate band. The only time they become chargeable, as they will here, is where the taxpayer sadly dies within 7 years. So that means that when doing the lifetime transfers chargeable on death computation, then we take account of the pets. But in lifetime, it's only the CLTs. So we therefore record that, and we then need to know about the taxability. Well, as we've said, the whole of the then available 325,000 nil rate band will be deductible. We'll have all of the nil rate band. So all of the first 325 out of the 402 will be chargeable as a nil rate. Then the excess, well, 402 minus 325, that will give us, what's that, 77,000. What rate will that then be taxable at? What tax charge will be applied to it? Now remember, that's where we needed to know, was the transfer gross or net, and what do those terms mean? If the donor pays, as is the case here, we noted on the question page, it is a net transfer. And as a net transfer, therefore, it is a 25% rate. So we're going to have a working that shows the £402,000 going in as the amount of the CLT. Oh, just notice there, of course, I think that should be 2012 there rather than July 11. My apologies for that. Another updating problem I've had there, I can see. But that 402 exceeds what was still the nil rate band in that tax year. 325,000 is at nil. 77,000 remains out of the 402. It is then the net rate of 25% that is applied. Why? Because the donor pays the tax. If the trustees had paid the tax, this would be a gross transfer, and you'd simply take 20% of the 77,000. But not here, it's net, and therefore it's 25%. Hopefully, I'm better with numbers than I am with dates, so I'm hoping that that figure of 19,250, here is the correct calculation. And because this figure was a net transfer, we must add the tax to it to get the gross transfer, 421,250. Now, if we'd gone on within the next 7 years to have made another CLT, then of course we would have had to have taxed that one by reference to the 421,250 already on the computation, which of course would have used up any such nil rate band. Now here there were no further CLTs, so that's it. Why do we need to know the gross transfer? Because sadly for Joe, he died within 7 years, and that means that that lifetime transfer chargeable when made is also going to be chargeable on death. And that therefore leads us now to that computation. Lifetime transfers chargeable on death. Died April the 1st, 18. We now need just 2 columns, the gross transfers and the tax column. The first of the transfers within that 7-year period, November 11. That was the pet. How much was it? 29,000. It gets first use of the nil rate band available at the date of death. It is still £325,000, more than sufficient to cover the 29,000 and therefore no tax. But of course, because it's there, that's using up 29,000 of the nil rate band and therefore pushing more of, then notice you pick up the gross amount of that CLT here. These are gross transfers recorded on there. This 29 is going to push 29,000 of that 421,250 out of the nil rate band and into the 40% band. So the available nil rate band for the CLT isn't 325, it is minus 29, 296. 296 out of 421,250, there that gross figure. At the death rate of 40% will hopefully be £50,100. In goes the tax figure, £50,100 there. But the question is that the amount of tax that will have to be paid? Now, if as here, there will be additional tax due as a result of the death of the taxpayer here, there will be additional tax on the trust. It will be the trustees that have to make the payment of that tax, but not out of their own pockets. The money will come out of the trust fund itself, therefore reducing the value of the trust fund, therefore meaning there's less to be distributed eventually to the beneficiaries of that trust. But is that the tax to pay? Well, no, it isn't, for 2 reasons. One, this date is July 12. The date of the death of the taxpayer was the 1st of April 18. That, therefore, is more than 3 years from the date of death. So, taper relief will be available to firstly reduce that tax charge. That will still leave tax still payable, but against that figure, there is lifetime tax to be credited. So again, what I'd like you to do here, please, is to pause at this particular point in time, work out what the taper relief will be, apply and deduct that, pick up your lifetime tax paid, deduct it, to establish the additional tax due on death. And then move on to work out, because there were 3 lifetime transfers chargeable on death, there was a further pet made in 2016, I think it was there. I need you to tax that as well. So could you work that, please, and then join us again to review. So let's see what we've got. We know that taper relief is the first deduction to be made, and there we're saying it's 60% based on surviving for between 5 to 6 years from the date of the transfer, July 12, through to the date of the death of the taxpayer, April 18. Yeah, July 12, 5 years on from July 12 would be July 17, 6 years on would be July 18, died between 17 and 18, July dates that is, so it's 5 to 6 years. That, again, you can look it up on the table, provided to you, but I would imagine that by the time you walk into the exam room, you probably know these figures anyway, as they move in simple 20 percentage points. So 60% reduction, apply that, all being well, if the calculation is correct, that leaves us with £20,040 to pay. But we don't pay that because we've made lifetime tax payment of £19,250. So it's not too bad, is it, that the amount of additional tax due on death is a mere £790. If required, of course, if you're required to do this, any such tax on a CLT become payable on death has to be paid by the trustees out of the trust fund, and like all tax on death is due 6 months after the end of the month in which the death occurred. On though to the last of the lifetime transfers, that was the December 16 PET. Now then, pick up the chargeable transfer figure. Be careful here, go back to your working. The transfer of value was 184, but the chargeable transfer figure after the exemptions, that is the figure to be taxed. That's 178. Don't go and pick up the transfer of value and bring that in. The whole point of doing the chargeable transfer working is that those are the figures that will be subjected to IHT. So it's 178. What do we have so far within the 7 years of the date of death? To this date, a cumulative total in excess of 450,000, which is in excess of 325, which means therefore that all of the 178 is charged at 40%. That would appear to be, I hope, but check it out, 71,200. It's a PET, so the only possible deduction from this tax charge would be taper relief, but to get taper relief you'd needed to have survived for 3 years from the date of transfer to the date of death. December 16 would have needed to survive to December 19 at least. Well, he died in April 18, so there is no taper relief. So 71,200 is the tax payable on that. Now this is on a PET. Who pays the tax on PETs? The individual donee. Whoever was the recipient, it was the son there, whoever was the recipient of that, it is they that pay that tax. And again, as ever, due 6 months after the end of the month in which the death occurred. Again, most important that in advising a taxpayer about gifts made in lifetime to their nearest and dearest, it would be important to get that information across to the beneficiaries, that if any individual is in receipt of a lifetime transfer that is otherwise a chargeable transfer, so it's not to the spouse or civil partner, then understand that depending on the amount of that transfer and the amount of any transfers that have gone before this, that if then the donor sadly dies within the next 7 years, you could lose up to 40% of that gift in terms of inheritance tax. That's a lot of tax to pay, so you better not spend it all until you know there is no tax to pay. The donor has thankfully survived for the requisite 7 years. This will be a bit of a shock here when £71,200 needs to be paid out. And after dealing with, that is it now for the lifetime transfers chargeable on death, there's only one more computation required. Not that you'll have to do the formal writing out of this in an OT question, but it is the listing exercise. So we've got the residence there, the main residence. As it's a repayment mortgage, not an endowment mortgage, we deduct the mortgage figure of 80, and we've got a net figure of 220. Now that net figure of 220, of course, is sufficient to ensure that down here we'll get the residence nil rate band of £100,000, the full amount available there, as 220 is more than £100,000. There's the holiday home, given the value of the Bank and Building Society deposits, the ISAs. Again, don't be put off by terms like ISAs there. You're thinking, oh, they're exempt. No, they're exempt in terms of the other taxes we've seen. The income is exempt income tax. Any gains on, say, shares in an ISA will be exempt CGT. They're not exempt on IHT. That's just another asset that you held when you die. Into the estate it goes. The other shareholding at £20 per share, that was 240,000. The life assurance, that was the proceeds figure that we picked up there, 140. So testing out a couple of valuation rules. As we agreed, the debts and the very reasonable funeral expenses there are allowable deductions, not the amount of the hospital bill or whatever it was that he'd agreed apparently to pay on behalf of a friend or neighbour. No, nothing that isn't legally enforceable gets to be deducted. So that's it. What we do get to deduct, though, before coming to the chargeable estate is any exempt bequests. That would be, of course, here to the spouse or otherwise to a civil partner. So we've got a chargeable estate of £758,000. Does that benefit from any nil rate band? Well, no, because the gross chargeable transfers in the 7 years before death, if you went back to that computation, the exact amount there doesn't really matter. The point is that 628,250 is a lot more than 325,000, meaning that none of the nil rate band was available. What is available, of course, as we've already said, is the residence nil rate band. That's 100,000 there at nil, leaving 658 to be taxed at 40%. And there is again a staggeringly large amount of tax that has to be paid in relation to the death estate. That will be paid by the executors, otherwise known as the personal representatives, of the deceased, paid by the executors, borne by whoever gets the residue of the estate. So that would be the son. So before the son gets the rest of the estate, after the exempt bequest to the spouse has been paid out, £263,200 of tax will be taken out of that estate. The rest of it will then go to the beneficiary. Okay, so there we have it. We've had a full working there dealing with everything that we might see in terms of an IHT computation. We had to compute chargeable transfers for the lifetime transfers. Because there was a CLT, we had to compute the tax on the lifetime transfer chargeable when made. And because there were both CLTs and PETs made within the 7 years of the date of death, we moved on to the lifetime transfers chargeable on death. And finally, as we've just seen, the chargeable estate at death. Computing in each case how much tax would be payable, and we'd be able to say who would have to pay that tax and when they'd have to pay the tax. Obviously, this last figure here, 263,200, everything on death is due 6 months after the end of the month in which the death occurred. Okay, check that out. There is one final session for us to have a go at, and it deals with one final computational issue that doesn't always get tested in the exam, but when it does often causes trouble. And it goes back to the cumulative nature of this tax, this cumulative donor-based tax. We know that on death, we only tax chargeable transfers made within the 7 years before death, be they PETs or be they CLTs. We know that in lifetime, we only tax CLTs there, not PETs, and that we work on a 7-year accumulation period. And what we then have to deal with is when dealing with the taxpayer's death. In this example, as we've just seen, all the lifetime transfers were made within the 7 years before death, so they all became chargeable as a result of the death of the taxpayer. Now, we already know that if there had been a PET more than 7 years before the date of death, then it was not chargeable when made, it was not chargeable on death, so the amount of that transfer was ignored. It would not be taxable, nor critically would it impact on anything that is taxable. If you had a PET 8 years before the date of death, another PET 6 years before the date of death, only the PET 6 years before the date of death would be taxable. And that would start with a fully available nil rate band of 325,000. None of it would be deemed to have been used on the earlier PET because it was potentially exempt when made, is exempt on death. It will not have come to any of the computations. What we're going to see to make that computation on death a little bit more interesting is, though we can ignore, for computation of tax purposes, pets made before the 7 years of the date of death, we cannot ignore CLTs that were made more than 7 years before the date of death. The fact that they were more than 7 years, like there was one 8 years before the date of death, means that on death there would be no additional tax to pay. But because it existed there, that means that if there was a pet 6 years before the date of death, whereas we could ignore the earlier pet, it would not be deemed to have used any of the available nil rate band. Sadly, as we're going to discover in our next session, if you've got a CLT 8 years before the date of death, so it is not chargeable on death, but it is within 7 years of any transfers that do fall within that critical period of 7 years before death and therefore become taxable. In calculating the tax on those taxable, those chargeable transfers, we've got to know the nil rate band. And what is unfortunate here is that that earlier CLT, though itself not being taxed on death, will use up some of the nil rate band that would otherwise have been available against those later transfers, therefore pushing more of those figures into the 40% band. And that's probably the trickiest thing that we have to handle. Now, don't worry about it at this point. I'll take you all through that and revise these rules. But before you move on to that next chapter, make sure that you've understood everything up until now and just play back this last bit about what I've said. So hopefully that will make what we then have to say in our final session together a little bit easier than it might otherwise be. Look forward to seeing you in our, or at least talking to you, I'd say, here in our hopefully final session on IHT, that next session that lies ahead of us.